Good evening, friends. Hope you are well and doing fine. I am Ashok Kanawala, and on behalf of HDFC Mutual Fund, extend a warm welcome to all of you to discuss our presentation on economy and market outlook, wars, inflation, interest rates, and more. The key event before us, the election is over, and with that, the volatility. As we all know, volatility is the nature of equity markets, and what best can be explained from developments in stock market over the last 3 days, up, down, up. More importantly, when it comes to election, of course, our elections are over, and we always highlighted that it's a key event for us as far as calendar year 24 is concerned. But also, it is equally important to know that this year, the world at large is going to see elections in number of countries. Nearly 40% of world population is going to see election this year. So we already had elections in Taiwan, in Russia, and after us, after a few months, there will be election in UK, and eventually we will end up with a election in US. Why I'm highlighting that? Because India today is a large country, fifth largest by economy in size, and also fifth largest by market cap in the world, and therefore we are very much part of the or integrated to the developments in the world. And election typically are always, before election there are policies which maybe a little bit populist or for whatever reason they tend to influence not only the local economy, but when a large economy like US etc. also goes into election, they also influence the global markets and global events. Therefore, once this key event is over for us, we thought to have this call, which wherein we are not going to discuss only the outlook for economy and market year on in terms of its valuation, in terms of opportunities, in terms of macroeconomy, how India is positioned right now when compared to the world, and also what should be the investment approach for the investor year on for the remaining part, at least till the time we get a clarity of the government formation and also the earning cycle, which is likely to begin from July. So we have with us Gopal Agarwal. Gopal needs no introduction. He is a veteran senior fund manager with us with more than 2 decades of experience. So we thought to have his thoughts, views on the uh, economy, on the market in terms of valuations, where are the opportunities small, mid, large, and what should be the investors' approach to this market year on at these levels. So without much ado, I will invite Gopal. With me is my colleague Ram, who will help me moderate the call once Gopal is done with his opening remark. So with this, over to you, Gopal.
Thank you. Thank you, Ashokji. So, I'll talk about the outlook on the market and economy post the general election and what we and the earning seasons of the Q4 is behind us. So, just to take you, every event has some repercussion, and whenever we are seeing post the very strong exit poll and then you saw the rally in the equity market and post the outcome of the election counting. We have seen yesterday, some nervousness. So this kind of volatility is a part of any growing market, and if that we have witnessed over the last 40 years, that every event has led to the volatility, but in the longer run, the market return coincide with the nominal GDP growth of the country. If you look at the last 40 years, despite all the events which has happened in the world, our Indian equity market has given, Sensex has given 13.2% CAGR return in the last 40 years, and which is more or less in line with our nominal GDP growth rate. And as our economy is now tending towards closer to 10% nominal GDP growth rate, and still we have the drivers for the growth. We expect the long-term potential for the market looks very good, despite the short-term volatility which we had witnessed. But this was like this is the event which has happened. So I will talk about the outlook and the road ahead. That how do we see? Now, if you just look at the general election, just to recap this, what has happened in this, the NDA has got the majority, but their absolute number of seats has fallen from 349 in last election to 291. And in this, what we have seen, the majority of the losses which has come from the northern belt and Maharashtra. So we have seen the majority of the around 62 number of the seats have been lost in the UP, Rajasthan, then Haryana and Maharashtra. So that's the thing. So what it also indicates that overall in the country, the economic policy and the reform agenda taken by the government is still well accepted, and so that's a continuity, and that is how the NDA has formed the majority in this election. Now, I want to share with you what market looks at from this government and what they have done. In the last couple of years, if you look at this slide, the capital expenditure growth is like 25%, 35%, and this year in budget they have talked about 17% growth. So in the last in the last 5 years, actually, capital expenditure has gone up by three times in 3x in the last 3 years, while you see the revenue expenditure side is quite flat. So that is what this government has done, is focusing on reducing the wasteful expenditure and increasing the capital expenditure. That is why you have seen the very strong earning growth in the investment led businesses, especially, let's say, defense, railway, power sector, and urban infrastructure. So that is why the majority of the rally in the last 2 years is into the investment led businesses. Now, that's a question most of the investors have, as now we will have a coalition government, after the 5 years of NDA government, but ruled by a majority party. But now we'll have a like a coalition government. So can it change? So reality is that still the 85% of the majority seat is owned by a single party. So the you may have a continuity in this policy, though there can be some expenditure towards the social agenda, because what we have seen in the many of the corporate results also, that the volume growth in the consumer led businesses and in rural India is a little bit weaker. So that there can be some increase in revenue expenditure and also social infrastructure spending. So I don't think it will have a very large dent on fiscal side also, because still, let's say we are likely to go to 5.1% fiscal deficit target for the FY 2025, based on the the interim budget which was presented. So still, because of the strong tax collection and RBI dividend, still we have a room of roughly 1.3 to 1.4 lakh crores extra to meet the baseline target of 5.1% fiscal deficit for FY25. So I don't see, like, even carrying out the social spending should not lead to digression to a larger extent on the fiscal deficit. But what needs to be seen, that in FY26 we have put up a fiscal deficit target of 4.5%. So we have to see whether the trajectory of that is important going ahead. But it depends on many factors. But what I would like to say, that near term, the bond market had seen the knee-jerk reaction. Yields have moved up, right, in a single day. But very clearly, we have some leg space because of very strong RBI dividend and strong buoyancy in tax collection. We can still meet the fiscal deficit target of FY25. So this knee-jerk reaction can subside as we move forward. Now, I want to share with you some strong tailwind in India. In India, the major fiscal deficit and current account issue comes from the higher energy prices. But what we are going to see because of after the Russia-Ukraine war, as soon as the gas prices reaches to $35 to $40 per million BTU, lot of investment has happened in this sector, primarily in Australia, US, and Qatar. So a lot of supply is likely to hit. So if you look at this chart, you are seeing from 2005 calendar year onward 3 years of very strong supply that we are not seen even the last 20 25 years. So because of this additional supply of LNG into the world market, and also some supply from UAE and other in countries in the Caribbean nation. So we are likely to see from a deficit of oil market to surplus in oil market zero point 0.1 and 1.3 million barrel based on the IEA estimate for CY25. So what it shows us that despite you are seeing the Middle East crisis, or you are seeing the issue with Russia-Ukraine war and what's happening in the Israel, and despite this the oil is where it is today. Today as we are talking, it is below $80 per barrel, but is still very comforting range of below $90 per barrel for India. So what I want to convey to you that our current account and fiscal should and even the fertilizer subsidy, which is directly linked with the energy prices, are likely to remain in a comfortable zone looking at the scenario in energy market. So this gives us a lot of comfort as an investing community, that though there is a short term changes from the baseline has happened on the political equation, but we are not in a big problem area, because of energy market is giving us a lot of comfort. Now I'll and also this government over the years has done very strong capital investment. As I explained to you, in the last 5 years, 3x increase in the capital expenditure has happened, which is helping the entire upliftment of GDP growth rate. This year we saw 8.2% growth rate, primarily led by the Capex, right? So we are on the comfortable side, and even our current account, our forex reserve, our even with the IMD forecasting normal monsoon. So so the inflationary basket is also under control. So this so we should not worry a lot about the short term thing, but on a long term parameter, things are moving right for India. So now I'll take you through the equity market side, where the valuations and all are behaving. So currently the Nifty, which is at 22,500 odd, is trading at 15% premium to the long-term average. And today, we are trading at close to 20 times FY25 earning, and that is there. And today the mid cap and small cap valuation is very high, and that is why the BSE 100 to BSE 500 market cap ratio is at 66%. So definitely broader market is more expensive than the Nifty, because in Nifty 44% of the stocks are trading at less than 20% premium. So the what I am saying, that the Nifty is not expensive, and it has some premium to the long term average, and as the earning visibility is good. So because of the knee-jerk reaction of what happens, some if some political thing leads to some uncertainty, we can have some correction in the market, but not to a large extent, because the valuation is not obnoxious, and so some moderation in valuation can happen, but we should not worry a lot about it. Second point is that mid caps are really trading at a premium, and this needs to be seen properly. And what we are seeing in the last quarterly result, since Nifty has an earning growth of 20% in Q4, while Midcap had an earning growth of only 7% and small cap had an earning growth of 13%. So the growth also for mid-cap companies had slowed down in the last quarter, and so there can be some excess valuation of mid-cap can be corrected because the earnings is also not supporting to a large extent. Now coming to the small cap, small cap is expensive, but it is not that very high as compared to mid cap. It is trading at 30% premium to the long term averages, and it has still 13% earning growth. The best part is that if you have to play the proper India growth story, the many businesses are primarily available into small cap, right? And the balance sheet of the small cap companies have repaired. The NSE 2, BSE 250 small cap index X of financial has a debt equity ratio of only 0.17 is to 1. So, that is why the stock can correct, for some reason, but I don't see a very deep cut because the balance sheet has repaired and there is no leverage, and still the earning the GDP growth rate was 8.2%, and even if it normalized to a lower level, but it's still manageable to a larger extent. And we are in a cycle of capital investment both by the corporate and by the government. Now, coming to the valuation side, I would like to share that small and mid cap index, largely, in the mid cap, the rally was more concentrated. So, top 20 stock out of 150 contributed 45% of the index movement, while in small cap, only 31% of the rally was contributed by the 20 stock. So that is what I'm saying, that 7% earning growth which we saw in Q4 for the mid cap is the lowest. So there can be some correction in the mid cap is possible if there is some uncertainty remains, while small cap still looks reasonable as compared to the mid cap. Now coming to the earning side of the Q4 earning, in Q4 we saw very strong earning growth for the Nifty 50 company of a 12% earning growth, and the market has the estimate between 5 to 7%. And we have seen very strong earning growth in automobile sector, financial sector, even healthcare and capital good, and cement has also outperformed the lower expectation. So the earning was very broad based, and what we have seen the some moderation in earnings in oil and gas sector and global cyclical, especially metals, where earnings was depressed. So we had a very strong earning growth last quarter. Auto had an earning growth of 32%, led by Tata Motor, Maruti, and Bajaj Auto. BFSI had grown by 22%, which is very strong. Capital goods sector had earning growth of 27%. So we have seen very strong earning growth in the last quarterly result. Now coming to full year basis, we have seen 1005 EPS for the FY 2024. The earning season ended. So if you look at holistically, the market in India on a trailing earning basis has never traded below 20 multiple, in the last 10 years. So you can have your inference the potential downside in the market, and based on the estimate, we can have a earning growth of around 12% for FY 25 based on the various brokerages estimate. So and in FY 26 we can have around 14% earning growth estimate. So we may have a earning of around 1300 around close by in FY 26. So if you even go with the long term multiple of 18 times, so it gives us good comfortable position that the Nifty can have a correction, but not very large. And if the as the a global rate cut cycle, which is various people have various expectation that maybe in the 6 to 9 months there can be a rate cut cycle in US, so it can be followed by a rate cut cycle in India. So in that scenario, there can be a chance of multiple expansion. And if these everything goes right with monsoon and political stability, then the you have seen that market in a bull market trades at a much higher multiple. So the earnings is your friend, fiscal deficit is supporting us, liquidity is now getting into relatively comfortable position. Today, the government balances in with RBI is close to 3 lakh crores. And if the government start spending post the formation of the new government, then you may see the liquidity in the system should improve, and which should support the overall activity in the economy. Now, I'll take you through some sectoral valuation where we are. So I would say in terms over the long-term averages, the consumer staple and private banks are more reasonable. Private banks are actually trading at discount to the long-term averages, while consumer staple and autos have and consumer discretionary has less than 15% premium to the long-term averages. So where like we are where like a lot of comfort is there on the valuation side. On IT services also had corrected in the last 2 3 months because of slowdown in US and and also possibility of higher for longer rate cycle. So big and data points are very volatile that. So now after the correction, many of the IT services stock are offering a dividend yield over 4%. So which also kind of provides us valuation support to the downside. That is where we are. While in pharma sector we are seeing very strong exports because of at higher interest rate in US. There is a shortage of drugs. Many companies are finding it unviable. So the pharma sector looks quite good. Especially we are seeing the good shortages in injectables and some generic drugs actually. Oil and gas, as I explained to you, that looks very solid because of energy market is quite balanced. And we are likely to see a good, marketing margin, and also the LNG market is likely to be an oversupplied, so which gives us a lot of support to the sector. I am structurally very bullish in India in power sector and defense sector. In power, now we are seeing a demand growth upwards of 6%. This year we saw 8% volume demand growth so far. So and with uncertainty in climate, we are seeing high. The temperatures worldwide is rising. So the demand for power is on a uptrend. So there can be let's say short term volatility, but structurally what is happening in power sector on the demand side and what is happening on defense side, it gives us a lot of comfort that these businesses are very structural in nature. Now I just take you through that India's valuation to the as compared to the other market. I would like to share that S&P is trading above long-term averages primarily because of seven mega stocks are trading at a premium, while remaining market is as at close to long-term averages. So that is why when the mother market is unlikely to correct very big time, so which supports the global equity valuation and global equity market to a larger extent. Now, I just share with you that so net I would like to share that India's growth continue to stand out well. Political stability is key to monitorable at this point of time. As macros are very favorable, there is some headroom for fiscal space too As I explained to you, we have roughly 1,30,000 odd crores extra, even to meet our baseline fiscal deficit target of 5.1% at this point of time. Corporate profitability as a percentage of GDP of India may temper earning growth, because last so far we had benefited a lot in terms of earning growth because of margin expansion, as these input prices, especially industrial commodity prices, was very benign. Now we are seeing some uptick in the industrial commodity prices, which may impact the margins going forward. That is the key risk for the big earning growth in many of the consumer facing businesses that we have to see. Now, India's valuation has risen both an absolute and relative standpoint of time, but large caps trade at a moderate premium. And as explained to you, we have seen, let's say, 1,000 plus EPS for FY24 on a reported basis, and likely to see 12% plus earning growth on a 2 year basis. So, which gives us a lot of support for the valuation of Nifty. Uh, uh, I would say that mid cap valuation is the most expensive. A small cap is a premium, but there is a earning growth also. So the on a relative basis, the small cap better than mid cap, and large cap is the most comfortable on valuation side. Now, on inflation side, inflation has fallen globally. And even in US, we are seeing some moderation in earning. And as the impact of higher interest rate is now visible in the on the housing market also, and even in the top end consumption. So we are seeing the data point is now really showing some moderation in the inflation. Growth has surprised positively, but outlook is unclear. A risk from falling accumulated saving. We are really seeing that savings rates even in India has decreased, but I would say risk. That is why the loan growth what we saw upwards of 18% can moderate to higher early teens rate actually. So some moderation so RBI is also likely to see that the our loan growth if we should in line with the deposit growth, so that the health of the system should remain. So that is where we are. Political uncertainty to get attention in US, geopolitical risk in Middle East to continue to rise. So net in this scenario, India offers a very good scenario of strong earning growth of double digit with moderate inflation, and fiscal deficit under control. In this scenario, when a developed country like US is also running 8% fiscal deficit, and even in the long run they are looking at 6% fiscal deficit. So on a relative basis, India looks attractive. So and any volatility in the market offers you to invest in equity with a medium to long term view. Don't carry away by any knee jerk reaction in the market, but be disciplined to use make volatility your friend. That is a message from me.
Thanks, Gopal, for a very comprehensive overview. आपने बढ़िया बताया. And that reminds me of a quote from Benjamin Graham, the legendary investor. In the short term, market is a voting machine. In the long run, it is a weighing machine. So it's a behavior. Before the election, nobody had understanding about the outcome. And so is the nature of market. ये मार्केट में क्या होगा किसी को पता नहीं है. And it remains volatile. So आज पड़ा है, कल घट भी सकता है, बढ़ भी सकता है. And that's how the market behave. But if you really look at the long-term picture, and between Gopal and me, we have been in market for more than 2 decades. 20 साल से ज्यादा है और हम लोग ने लगभग 5 elections देखे हैं. So for example, I will give you example of 2004. The election outcome was not to the expectation market. Market corrected by nearly 1,400 points in just short period of time, from 6,000 to 4,500. And in no time, again from 4,500 became 21,000 by 2008. Then again, if I go back to 2009 and market was expecting something else and the outcome was again positive for the market at that point in time and it opened to circuit the next day. So, but overall, from a medium to long term perspective, it's a daily volatility which happens with the outcome of the election, but long term picture doesn't change. It is very much as Gopal rightly explained, it is linked to nominal GDP of the country, which we have been seeing for last 40 years, and the corporate profitability. And that's where Gopal came back to you with an understanding of what the corporate profitability is likely to grow over the next couple of years. And that's what you can expect as a medium to long term return from the market. And therefore, we say this market is for patient investors, those people who can come to market from a medium to long term perspective. And for the short term people, trader type personality, you have to live with this kind of volatility and, of course, the losses or profits as the case may be.
Thank you very much. Thank you all for joining.
Thank you, guys.
Okay.
Bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.